When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave, Chase, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Welcome to another edition of the Retire Your Way podcast with Chase Lopez at ILG Financial. You can go to ilgfinancial.com anytime and find out more about ILG. And you can also call this number 540-720-5656. That's 540-720-5656. But we're going to talk about taxes and tax diversification, a lot of other interesting things today. And Chase, how are you, my friend?
Oh, doing great. Love for us to get together and be able to share some unique topics with the audience. So every time we get together on, it is the light of my day. So appreciate you jumping on here today.
Well, we always talk about getting to and through retirement. And today, our topic of discussion will be tax diversification and retirement. And as we all know too well, tax season is here. For those in or near retirement, you're probably making those last-minute contributions to retirement funds in order to take advantage of tax benefits this year. But what a lot of people don't consider is the importance of where you put your money when you make those contributions. Chase, why is this so important, and what should people be aware of this tax season?
Yeah, thanks, Ron. So different types of retirement accounts, they just offer different tax advantages in retirement once we get to, that distribution phase, which has been a common theme throughout all of our podcasts. And how and when you withdraw that money from these various accounts can determine how much you pay in taxes. So the theme of today specifically is that diversifying the types of accounts is just as important as diversifying the types of investments you make. Before today, I pulled a quote, and it's from Maria Bruno. She's Vanguard's head of U.S. planning research, and it was a very poignant quote, in my opinion, almost too obvious, I guess, for lack of a better term. And she says, every dollar you lose in taxes is $1 less in your pocket. So holding different account types can help you manage the uncertainty around future tax rates, because we just don't know in 20 or 30 years what the tax regime will be or what your personal tax rate might look like in the future.
You said Maria Bruno. I thought you were about to say Bruno Mars. Are you any relation?
He probably has some good tax advice as well.
I'm sure he's dealt with it some. Now, before we get into why tax diversification is important, can you give us a brief definition of exactly what tax diversification is?
Sure. So everyone is very familiar with investment diversification, right? Investment diversification is just spreading your investments across a variety of assets like stocks, bonds, cash, certificates of deposits, maybe some precious metals. This protects your money from mild market swings. If one asset class doesn't do as well as the other, well, at least you have some money sprinkled in every single one.
Okay.
Well, what we're going to talk about today is how you can do the exact same thing with tax and balance sheet diversification. You can use various types of accounts, and this gives you the flexibility to spend your money from different accounts to maximize the tax savings when you retire.
Now, how does tax diversification help you save?
Yeah, let's look at a quick hypothetical scenario. Now, I'll warn the viewers, I'm going to throw around some numbers as we're talking here, so sometimes it can get a little bit wonky when you're hearing this via audio. So before I jump into that scenario, when you talk about your specific scenario, you really want to talk to your financial professional to see how these things will affect you. But this hypothetical scenario that we're talking about, Jim has retired and he does not yet have to take required minimum distributions from his retirement accounts, or he doesn't have to take Social Security yet. He paid zero taxes on $100,000 from a taxable account. So a lot of people ask, well, how did he pay, zero taxes on $100,000? Sounds like a great deal. Well, when Jim stopped working, he and his wife's income, it fell sharply, allowing him to take that $100,000 from a taxable account and then take some deductions to push their income below the threshold that allows you to skip capital gains altogether. For joint filers, at least in 2023, that's approximately $89,000. This means that they had to take out less out of their account to spend for the year, which preserved a lot of their savings because none of it had to go to taxes. Now, again, this is an atypical scenario, right? This is kind of a special case, but it does demonstrate the possible benefits of tax diversification inside of your accounts.
Yeah, that is definitely kind of different. So actually a pretty good scenario for those folks. How should I diversify my retirement portfolio? And if I'm doing that, what account should I use for tax diversification?
Yeah, so there's really 3 different types of investment accounts that you can have in respect to how they're taxed. So we have fully taxable accounts. So another word for that is the tax as you go account. So that's an example of that is a brokerage account. These accounts are funded with after-tax money, and the taxes are paid annually on the dividends, interest earnings, or capital gains if you sell an asset. They're not subject to those required minimum distributions after age 73. And money withdrawn from these accounts are taxed as capital gains, which is generally more a favorable rate than ordinary income, at least the way the tax code reads now. Now, we're recording this March of 2023. There may be changes to that tax code in the future, but at least the way it reads now, that's a generally more favorable rate. So that's the first type of investment account that's taxable. The second is what we call our tax deferred accounts. And really, everyone who has a 401k or for federal government employees, TSPs, they're all very familiar with these tax deferred accounts. Another example is a traditional IRA. And these accounts are funded with money you haven't paid any tax on yet. So you get the tax deduction up front, the money goes into the account, and it grows tax deferred until you withdraw it in retirement. Now, some people may say, well, what if I never retire it? I'll never pay the tax. Well, unfortunately, that's not an option, right? The government, it requires you. That goes back to the required minimum distributions that we were talking about before. Government requires you right now, at least, age 73 to start taking money out of those accounts. You have to pay the taxes, and then you can really do with the money what you want with it. So the first one was fully taxable accounts. The next one was those tax deferred accounts. And then the last type of tax diversification or different tax account is what we call tax-free accounts. And a great example of this is a Roth IRA or a Roth 401k. These accounts are funded with after-tax dollars, so you don't get the tax deduction up front. You pay the tax on the money. It goes into your Roth IRA or your Roth 401k, and that money grows tax-free for really the rest of your life. And then whenever you take the money out, if you ever take it out, it comes out tax-free as well. So great benefit there. By the way, you can contribute to a Roth IRA in 2023 only if your modified adjusted gross income is less than $153,000 for a single filer and $228,000 for a joint filer. However, some companies offer Roth 401ks, so you can do it through your employer. But really, those are the 3 different types of accounts when it comes to investment accounts and how they're taxed.
If you would take a moment here and explain a little further about some fully taxable accounts, tell us some examples here.
Yeah, so for the fully taxable accounts, that was the first one that we talked about there. Really, those are just your typical brokerage account, right? So if you log on to Charles Schwab or Vanguard or Fidelity, those are the 3 big ones. You can open up with really the click of a button now with technology. You can open up what's called a regular, fully taxable brokerage account, and you can deposit, as much money as you want in there, really at any given time. And you can really invest in really whatever is available to you. So that with that account, it offers kind of the most flexibility as far as what you can invest in and how much you can contribute or put in that account.
So just to kind of sum up all of that, you have fully taxable accounts, tax-deferred accounts, tax-free accounts, like all those things you had to say about Roth IRAs, and those are very attractive in certain situations. Now that we know what it means and what it should all look like, how do we get there? Is there a strategy or a certain path forward?
Yeah, that's a great question, Ron. And this is actually with the tax changes that are very much in news now. That's very much a political sticking point nowadays. It's important to remember that there's not a one size fits all solution or strategy or answer when it comes to overall retirement planning, but also specifically with which accounts you should use for your investments. Everyone has their own goals. They have their own timelines and factors in their retirement equation. So let's take a look at a few different guidelines to be aware of. Then you can map out the best strategy for you in your situation with your financial professional. Mm-hmm. So between the ages of 59 and a half and 73, if you have stopped working or if you only work part-time and you're old enough, this means by being over age 59 and a half, this means you're old enough to withdraw from those tax-deferred accounts without any penalties, but it's before you have to take those required minimum distributions, you may want to consider gradually reducing your tax-deferred accounts. So the idea there is we could start gradually taking money out of these tax-deferred accounts. You can move it to tax-free accounts. Those withdrawals are taxed at ordinary income, but without a large paycheck, if you're retired, you'll likely be in a lower tax bracket and pay less taxes. So that's just one strategy. Again, just to kind of reiterate what we said at the top here, not a one-size-fits-all strategy. We always encourage folks to get with their financial professional before they make any big moves like this, because there are going to be consequences of doing these things. So we just want to make sure that we're all on the same page.
We're talking a little strategy here about tax diversification, and I just wanted to jump in and remind everybody that you're listening to the Retire Your Way podcast with Chase Lopez. Number to call if you'd like to have a conversation with Chase or Dave about your situation, 540-720-5656. Okay, more tax diversification strategies and guidelines. Here once again is Chase Lopez.
Yeah, so we were just talking about, some different strategies to diversify some of these taxable accounts and how you can kind of go about it. So the first one we kind of discussed is if you're above the age of 59 and a half and you're under required minimum distribution age, you can consider moving some of that money from tax-deferred buckets to tax-free buckets, a Roth as an example. The only downside there is you're paying the tax now to get that money into tax-free buckets. But if your income has been drastically reduced as a result of retiring, well, then you may be in a lower tax bracket and may be able to kind of take advantage of that. Also, while you're working and you contribute to your company's 401k to at least get the company match if one is offered, and take that tax benefit. If you're under 35, we tell a lot of people that are under 35, you may want to consider contributing to a Roth IRA to take advantage of that tax-free growth. Because in your early working years, your tax bracket is likely lower than when it is in what we call your peak earning years, so later on in your career. So the benefit of the tax deduction is far outweighed by the potential for that tax-free growth. In your peak earning years, generally between mid-30s and 50s, contributing to the tax-deferred accounts and getting that immediate tax deduction, since you are, making more money, or at least that's the thought, right?
That's the way it works for most folks anyway.
Right. It may be better to take that tax deduction up front than getting that tax-free growth. So again, it's very individualized to every single person, but generally, from a more general perspective, what we tell folks is you definitely want money in all three of these buckets. So the fully taxable, the tax-free, and the tax-deferred just puts you in a position to be more in control if there are any tax changes, down the line.
There's so much to learn here and so much to know. And I would imagine that this is just all this tax diversification ideas that we're talking about here. That's just another strong reason to talk to a financial professional such as yourself at ILG Financial.
Oh, 100%, Ron. And really stuff that we're talking about today is very general. The analogy I like to use is really this is just the tip of the iceberg, right? Really with everyone's individual plan, everyone's individual situation, there are considerations to make. And really it's very necessary to do a deep dive into each individual's different financial picture. Mm-hmm. So, for example, there are things called, FSAs, HSAs, 529 accounts. These are all different tax advantaged accounts that are out there that have their own different use. So just really, again, that's a podcast for another day to talk about those accounts. But just goes to show you, to your point, there's a lot of information out there. It can be, I made this joke with a client before. Now with the internet and everything, it's almost like we have information overload now. Yeah. We almost have too much information to kind of siphon through. And that's really where, a financial professional like ourselves come in, where we can get through all of the noise and help you see, hey, what is actually applicable to your life.
And let me add that also, if you're trying to do this yourself, there's a lot of misinformation out there as well. And
Absolutely.
So you need somebody who knows what he or she is doing to help you cut through all that noise out there. So I see a common theme is everybody wants to reduce taxes. Everybody knows that, but doing so is going to be different for everybody. It's going to be different depending on your particular scenario.
100%. And we're specifically talking about the tax situation here today. But that's largely applicable to, really everything in our financial lives, right? Everything is very, very specific to your own situation. So again, the takeaway here is with everything we talk about on the podcast and on the YouTube show, which goes by the same name, of course, subtle plug there. There's no golden solution that helps everyone accomplish the same thing. That's because not everyone is trying to accomplish the same thing. Everyone has their own goals and their own needs that they need in retirement. So it is crucial to take action, but it is even more important to have a financial professional on your side to help you walk through all of the different options and solutions that work specifically for you.
Chase, I feel as if I've learned a lot today just in this conversation about tax diversification and retirement. And I know a lot of folks out there may want to give you a call and have a longer conversation about all of this. Why is it so important for folks to call and get in touch with ILG Financial right now?
Really, the biggest thing, right, is to just see where you are, right? A lot of the things that we talk about here on the podcast, you may or may not know if they specifically apply to your situation. Well, the first step is to figure out if they do, right? Figure out if these different scenarios fit your specific situation. And what we can do is shed some light on some things that maybe you just haven't heard of before, maybe show you some concepts that maybe you just weren't even aware of. We go by the old adage, you don't know what you don't know, right? So that's really what we're here for, is just to educate folks out there. And hopefully the podcast helps at least spurn some curiosity on their end to give us a call and look further into their situation.
Well, Chase, it's been a pleasure being with you today. I know you've helped a lot of folks, and I'm already looking forward to next time we get together on the next podcast.
Oh, absolutely. Hey, thanks again, Ron, for hosting here today. It's always a treat getting together with you. When I see it on my calendar on Fridays, I'm like, yes, we're doing the podcast this weekend. We get to talk to the listeners about a new topic. So sincerely, thank you, and we'll talk soon.
I do know you love helping people. Now you are one step closer to learning what a customized retirement strategy can do for you. And it's all about income, legacy, growth, all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656 or go online to ilgfinancial.com to learn more. And once again, that phone number is 540-720-5656. I'm Ron Stutz. He's Chase Lopez. Thanks for listening to the Retire Your Way podcast. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, a registered investment advisor. AlphaStar and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.